What is up, guys? I hope you're doing well. James here from jamesdforsythe.com. And I wanted to share this little, very interesting article, I guess, blog post slash column, whatever you want to call it, by looks like four various PhD students or actual professors over in Germany, specifically with respect to the ECB. Um, Basically, it's titled Deciphering Monetary Policy Shocks. And so it really looks into like various kinds of communication that you can get from central banks and with respect to different, I get topics is how they kind of break it up. So like rate guidance, economic activity, financial conditions, just as examples, and kind of breaking those up and seeing like, okay, when the central bank talks about rate guidance, whether it be easing, staying neutral, or tightening. And then the other ones are basically like with financial conditions. If they talk about it in a positive light, how is that affecting specifically like asset prices, right? And so with that being said, I'll go over to the screen share to show you guys the actual thing. So, and then I'll make it bigger for you guys. Okay, so basically they say a standard approach to assessing monetary policy shocks is to measure high-frequency market price reactions around central bank announcements. And so they basically take these comments or announcements from central banks and really kind of analyze them based off of text, it seems. So like what they actually said, um, and kind of going from there and measuring how that affects markets to a certain degree, right? And they describe all of these as shocks. So I'm assuming it's basically just like, the announcement comes out and then massive moves start happening or some form of volatility starts happening, right? And so in a recent paper with the citation, um, we propose to identify monetary policy shocks directly from the contents of central banks' verbal communication with the public. Put differently, instead of inferring an economic interpretation indirectly from asset price movements, we connect market responses directly to what the central bank actually says, right? So I guess instead of like looking at what assets are doing, whether it be stock prices or bond prices, because they do have OIS spreads in here, or yeah. And so basically, instead of looking at what those prices are doing, they'll sit there and sorry, instead of looking at those prices and seeing what they're doing and making their assumptions based off of that and how the market is kind of pricing in this stuff, they're instead looking directly at the announcements and then using and then comparing that to the the asset prices, I guess indirectly, right? But anyways, they break up these kind of policy shocks into five different topics: rate guidance, economic activity, inflation, financial and monetary conditions, and fiscal policy, right? And so they use textual analysis and they measure. This is all with respect to the ECB, right? With what they're actually doing for the ECB's announcements, but it's also like it seems rather similar to that of the Fed in terms of like how you would analyze this. And so that and all of for conferences between January 2002 and July 2020. So about almost 20 years, 18 and a half or so. So for rate guidance, they basically rated this based off of easing, unchanged policy, or tightening, and they basically did like a -101, respectively, kind of rating that to see how it goes. And then the other topics, they basically measured the ECB's tone by assessing the prevalence of negative words with respect to that topic, right? And so here in figure one, we can see like this is what I was talking about with the rate guidance, where you have a one for I think it's easing. No, the other way around. One for tightening, and then -1 for easing. And so you see how that kind of travels, I guess, throughout time. And so you see really congestive for tightening from looks like 2004 to almost I will say 2009 ish, and so I'm not as familiar with European financial history. Um, and so I'd assume somewhere around here, when the early to mid 2010s, I believe that's when the European debt crisis happened. But like I said, I'm not as familiar with it. And then for the other topics, it was kind of the weighting, I guess you could say, for the words they use, measuring the actual tone. So I think 1, the highest number, implies or is, like, very positive, and so, like, the closer it is to 1, the more positive the results, and so these large dips are kinda negative sentiment. So you see, like, economic activity declines dramatically during, 2008 era-ish, and so the GFC, which, I mean, that was a kind of a global phenomenon anyway. Same thing with financial monetary conditions. Um, Inflation, you saw a bit of the same thing, and then fiscal policy is kind of not even it's so volatile, it seems, especially specific to that area, that it looks like it didn't have much of an effect, um, with that respect, but you can kinda see, like, how the sentiment goes. I think one thing to note is it pretty much always close to 1, and so I think that kinda shows how central banks are always skew or try to shed a positive light on everything because everyone kind of believes that they're in charge of all of it, and so, of course, they're going to have just be like, "Oh, everything's doing fine." Like, financial conditions and monetary conditions are fine, the economy's great, things like that. Um, so even when it's obviously not doing so well in terms of, like, actual, like, regular people on the ground working every day and they know it's not doing that great, at least with their, I guess, anecdotal perspective, it's pretty much always gonna show central banks are always gonna say that, everything's doing well, right? It's kind of the incentive. Um, and this kind of reflects that it's always close to 1, and, like, the lowest it gets on these graphs is, like, point 0.9, and so still and it looks like the lowest for economic activity was around 2008-ish, and that was around point 0.9, so it's like this doesn't seem very negative at all, on a relative basis, but without having I mean, it doesn't even go that low. So it's like, with that being said, how negative do they have to be in order to be closer to 0 with this respect? But anyways, so this is kind of continuing on and breaking it up into different parts of the markets, right? So this one really shows how asset prices respond to topic-specific news, and this is around short windows. And so I had to actually I'm not a statistician or anything, so looking up into these are significance levels for each of these bars, and so the dark ones are 1%, and then 5% is kinda light grayish, and then I'm sorry, I guess regular gray. I mean, they're all kinda gray or black, so varying shades of gray. And then you have the really light gray, which is 10%. And so significant levels, it seems like it's basically the probability of rejecting a hypothesis when it's true. And so at least that's kind of the definition of it. And so the darker it is, like for the 1%, it's like there's a 1% chance that um, basically whatever the central bank says, and we're going to look at the rate guidance for, let's do exchange rates for Europe to the British pound, it looks. And so basically for this bar, it's saying that in terms of financial and monetary conditions, there's a 1% chance that whatever the central bank, the ECB specifically says, will be rejected in this respect, right, for this topic, right? And that's kind of the general idea. And then I'm assuming the actual x-axis is an actual percentage, I guess, because it's one of those it doesn't really have say anything, and there's not like a footnote or whatever. So I'm assuming this is like I don't know if it's a I don't think it's a probability because it gets negative. So I'm thinking it's like an actual like spread because this says sovereign spreads. And so for the negative ones, I'm assuming this is like the actual difference in rates. And then so you can kind of see how it's changing via topic. And if you notice, like, a specific topic like rate guidance doesn't actually change everything, right? So it's not measured. Or I don't know if it's not measured, but it doesn't have a significant effect on every single category. So like the rate guidance is more specific to interest rates. But it doesn't really affect sovereign spreads or exchange rates in this respect, right? Or at least in how they measure. And then basically the same with all of them. Each one pretty much only seems like each one seems like it's only affected by like one, maybe two things, because all of them only have one bar. But the interest rates OIS, like the 2 year, have two, which are affected by rate guidance and economic activity. This is kind of, and then inflation doesn't have anything, if you notice. And so I think they make a comment about that later. Basically, how topics of inflation are kind of, as they say, absorbed into everything. I don't know how much that would have changed, which I think is kind of surprising given that these take and the data was with respect to press conferences all the way up to July 2022. And so I haven't been following inflation much more in the Eurozone, but I know it's a little bit below that of the United States right now because we had a CPI print of 9.1, and then I think the Eurozone's is 8.5, and this is would be as of July 2022. So I don't know, but anyways, they find that this is what they're talking about. That finally we find that any news about inflation is subsumed by communication about other topics during our sample period. So basically, any weighting, I guess you could say, for inflation related topics are kind of tucked into the rest of these bars, so to speak. So it's important to note that market responses to topic specific news can change over time. And I guess this is showing it's the sensitivities. And so you go from 0 down to, looks like all of them are around maybe -3-ish around the bottom of it. And so it's kind of showing you like how sensitive it is to it. So I'm assuming when it dips down, it's showing how they're not as sensitive to certain topics. And so it's showing each individual indicator. And so they have like the Spanish and German 5 year spread, and then I think this is Italian and German 5 year spread. And it's kind of showing how sensitive it is to it. So when it dips down for the years like around 2010 all the way up to 20, that almost that entire 2010 decade, not as sensitive to these kind of news to the news that happens from these things. I don't know why my brain just isn't working this morning. But anyways, the recent literature has proposed a range of such shock measures based on the joint responses of interest rates with different maturities and or stock prices. So figure 4, which is similar to the one we were talking about a minute ago, summarizes how 3 sets of shock measures suggested by previous research can be connected to the topic-specific news that we identify from ECB statements, right? And they give the sensitivities of the different monetary policy shocks, right? And this is from 3 different papers and kind of what they found, so to speak. And so you can see same thing with the significance levels, and they're only looking at 3 topics now. And this is with respect to, they all kind of look at different things. So like Altavilla et al. Looks at like timing, forward guidance, and QE. And then the other ones are like policy, information, monetary, growth, and risk premium. They kind of look into the different things. And so they start to look at shocks to the term structure of interest rates characterized. Wow. Today is just not a good day, apparently. But characterized in terms of the 3 factors suggested by Altavilla, which is a timing factor, which reflects short term yields, forward guidance, which is kind of the middle of the yield curve, and then quantitative easing, which is more of long-term yields. And then this corroborates the interpretations with the same paper apparently, where they find that the timing factor is driven by news about rate guidance. Their forward guidance factor is significantly related to news about economic activity, and then whereas their QE factor is mostly driven about news about financial conditions. So it's kind of breaking up the different factors into where on the yield curve it would affect, right? And so timing seems to be more short-term yields, and this is reflected by its kind of sensitivity to rate guidance, which kind of makes sense. Where, like for example, with the Fed, when they raise Fed funds, it's supposed to have a much higher effect on short-term yields with like overnight rates, and then kind of all the way out to the 1 year, from my understanding, ish. So basically, like T-bills is where they have more sway in that respect, and then you have forward guidance, which is kind of more related to economic activity. And so from there, it's kind of like that's more of like middle of the yield curve ish. So like if the economy is doing well, um, it will be more people like investors will look at it more positively from like a 2 to 5 year horizon, maybe 10 year. Um, but kind of that respect, I'd probably put that more closer to five, but I'm not a bond expert. And then QE and financial conditions seems to be more like a longer term thing where you're going out to like 10, 30 year sort of thing. Um, just kind of just breaking it up into different sections, right? And so they also find some other things like, and they have kind of an example. So, like, suppose a central bank announcement is accompanied by an unexpected increase in interest rates. In the case of a policy shock, one should observe that stock prices decrease due to higher discount rates. By contrast, in the case of an information shock from unexpectedly good news about the economy, one should observe an increase in stock prices as well due to higher cash flow expectations. So I think this kind of shows a couple things. So one, there's different types of shocks as they're defining it. So one, they say is like a policy shock, and then the other one is they say is an information shock. So it kind of depends on what specifically is being portrayed, I guess you could say, right? And so from there, um, yeah. But another thing to note from this is that there are a lot of cross currents. So you have one shock that could basically be you have one kind of cross current pulling prices down, or kind of swaying them in that way. And then you have another one doing quite the opposite. And so it's really like almost a tug of war between different factors, which I think is one of the reasons why it can be so difficult to see and kind of forecast price direction in a way, right? Because of these things, to where there's so many different factors pushing in different directions, right? And so basically, they find that the price-based interpretations are consistent with the actual news communicated by the ECB. So policy shocks load significantly on news about rate guidance, whereas information shocks are significantly related to news about economic activity, but not to news about rate guidance, right? And so they find that monetary shocks are closely related to news about rate guidance. Growth shocks, so there's another one, are most closely related to economic activity, and that risk premium shocks are significantly affected by news about financial conditions. So the last result is again consistent with the role of intermediaries for asset prices, right? So I guess it's like pricing in risk premiums for maybe different types of insurance, different types of derivatives. So whether that be like options, maybe some futures, I'm not as familiar with those, and other sorts of things. And so I guess kind of main takeaways, for me at least, is that you really have to kind of categorize these things into different things. Um, how many times can I say things in the same sentence? But you have to be able to categorize and kind of separate how you're defining these shocks, right? So, like, news on different things should have an effect on So like news about rate guidance or different topics, I should say. So economic activity. And you really have to kind of separate those effects um, and go from there, it seems. So I don't know, I'm going to read the next couple papers. Um, at least the ones that they cite, especially with the ones where they actually like are kind of using their definitions here, like with how they're defining growth and the other types of shocks. Um, I just found this this morning when I was going through my alerts and stuff, and I just thought it was interesting, so I thought I would share it with you guys. But anyways, I'm gonna leave that there. Obviously, I'm gonna put the actual link to this, I guess, column in the description so you guys can read it yourself. And like I said, I'm not a statistician or anything, so especially with this graph when it's talking about the sensitivities, like kind of is I'm assuming 0 is like the most sensitive, and then maybe down is like I'm assuming not as sensitive, or maybe like sensitive, kind of like a negative correlation in a way. I'm not 100% sure. Um, but yeah. Anyways, if you guys have any comments, if you want to discuss some of the charts, or maybe you see something that I didn't before, feel free to comment it and have a discussion about it. So with that, I'll leave that there, and I hope you guys have a good night, and I'll see you on